Hi, Artemis Paint here. If you've been trading for some time, you probably know what market efficiency means in general terms. You may have heard people say that you can't win money by trading on Betfair because the markets are too efficient. Is this true, or is it an assumption? In fact, there are two assumptions embedded in the statement. The first is that the Betfair markets are efficient, and the second is the assumption that it's impossible to make money in an efficient market. In this video, I will dive deeper into the concept of efficiency. In addition, I'll discuss whether the Betfair markets are efficient and whether it's possible to make money from an efficient market. And if you only have a basic knowledge of market efficiency, this video will provide you with a useful insight into the Betfair markets. So let's get started. Betfair SPs might not be efficient in the way that we usually think of efficiency. The argument that Betfair SPs are efficient goes as follows. If you back every favourite, you will lose money. If you lay every favourite, you will also lose money. So the conclusion is the Betfair SPs are highly efficient. The premises are correct. Whether the conclusion is correct depends on how you think of efficiency. Let's assume that we're talking about horse racing. On average, the Betfair SPs will reflect the true price of the favourite. In this chart, the blue diagonal line represents the true probability of the Betfair odds. The red dots represent horses. If their odds represent the true probability, the red dots should appear on the blue line. However, it's unlikely that all individual favourites start the race at the correct price. It's more likely that some will have big odds compared to their probability of winning. In this case, the dots will fall above the blue line, and there will be others that will have short odds relative to their chance of winning, and these will fall below the blue line. And when you put the overpriced and underpriced favourites together and calculate an average, the Betfair SPs will appear to be efficient. Therefore, the horse's odds will be efficient on average, or collectively efficient, but not necessarily individually efficient. And intuitively, it seems almost impossible that a computer can calculate the correct probabilities for all outcomes in sporting events throughout the year. Fundamental analysts who know something about the sport may be able to take advantage of this possible lack of individual efficiency. In this video, I'll present a theory on the market that comes from financial trading. Most of the serious research on sports markets has been conducted by economists and financial analysts. They research sports markets with the aim of getting a better understanding of financial markets. Therefore, it makes sense that we should look at theories from financial markets with the aim of getting a better understanding of sports markets. Sports markets are different from financial markets. Therefore, we need to figure out which theories from the financial sector are usable for sports traders. So what's in this video? Firstly, I'll explain the efficient market hypothesis. According to the hypothesis, there are 3 levels of efficiency. Secondly, I'll explain how you can tell the level of efficiency of a market. Thirdly, I'll discuss the causes of market inefficiency. I'll explain the difference between market anomalies and pricing anomalies. And finally, I'll explain what this all means for sports traders. So let's get started. So now I'll explain the efficient market hypothesis, which is also known as the EMH. The origins of the efficient market hypothesis are derived from work conducted by Eugene Farmer in the 1960s and 70s. In his work on financial markets, Farmer defined an efficient market as a market in which prices always fully reflect available information. In other words, he was saying that prices are at the level that they should be at. Three types of efficiency evolved from Farmer's EMH hypothesis, namely strong form efficiency, semi-strong form efficiency, and weak form efficiency. And these theories were developed by an economics professor, Burton G. Malkiel. I will define these three types of efficiency. As the name suggests, strong form efficiency is the strongest form of efficiency. In the stock market, strong form efficiency means that all market information is factored into the price of a stock. This means that the investor can't gain an advantage from inside information, fundamental analysis, or technical analysis. It's easy to jump to the conclusion that trading is not viable in a strong form efficient market. However, for sports traders, this isn't necessarily the case. I'll explain later that certain types of strong form efficient markets can be good for scalping. There's an important difference between a strong form efficient market in financials and sports. That is, financial market prices are prone to changes due to random news events. For example, if war breaks out on the other side of the world, or the price of oil goes up, or people vote for Brexit, this might result in changes in prices in financial markets. However, such events won't alter the odds of a tennis match at Wimbledon. Therefore, compared to a financial market, when a sports market is strong form efficient, prices are more likely to be stable. And this is why pre-match scalping may be a viable trading strategy in certain strong form efficient markets. The fact is, you won't see many strong form efficient markets on the betting exchanges. However, you will see a lot of semi-strong efficient markets. Semi-strong efficiency is the second strongest form of efficiency. Semi-strong form efficiency asserts that historical and current publicly available information is factored into the price of a stock. Unlike strong form efficiency, semi-strong form efficiency doesn't assume that inside information is factored into the price. This means that the investor can't gain an advantage from fundamental analysis or technical analysis. However, the investor can gain an advantage from inside information. If the market is semi-strong efficient, this implies that only insiders, such as bookmakers and other smart money traders, can win. Again, as with strong form efficient markets, there may be certain conditions in semi-strong markets in which scalping is a viable option. However, because inside information can influence semi-strong form efficient markets, you could argue that these markets are more difficult to scalp than strong form efficient markets. And I'll talk more about how to find situations in which inside information has a reduced effect on scalping later in the video. Weak form efficiency contends that past price movements do not affect current or future prices. Weak form efficiency asserts that historical and current publicly available information is factored into the price of a stock. This means that you can't gain an advantage from technical analysis. However, according to the theory, the investor can gain an advantage from inside information and fundamental analysis. So weak form efficiency is similar to semi-strong form efficiency, the main difference being that the theory concedes that in a weak form efficient market, traders can find an edge by using fundamental analysis. And later in the video, I'll explain that in specific situations, all categories of efficiency are potentially tradable. So, how can you tell the level of market efficiency? In sports trading, we can narrow down the type of efficiency of the market, although we can't always determine the exact level of efficiency. In a strong form market, all market information, including private news, is factored into the odds. Therefore, if the market moves in either direction in response to previously private news, the maximum level of market efficiency is the semi-strong form. For example, if a well-known tipster releases a tip and this results in the market to move, this means that the market is not strong form efficient. Such a market will be semi-strong efficient at best. Similarly, when the odds move in a football match after the team sheets are published, this suggests that the market is semi-strong efficient at best. So I'm assuming here that the team sheets had been private information prior to them being published. To show that a market is weak form efficient, there has to be mispricing in the market that can be picked up by fundamental analysis. This is difficult for the individual trader to prove. However, there is published research that shows that mispricings do occur. Several studies suggest that the betting markets are generally weak form efficient. For example, computer-based forecasting models have been shown to produce profits for a wide range of sports, including tennis, horse racing, football, as in soccer, Australian rules football, and American football. The computer-based models used a combination of form-based and statistical inputs, and many of these studies used bookmakers and not betting exchanges. As betting exchanges give better odds and have a smaller overround than bookmakers, the authors of some of these studies would probably have obtained superior results if they'd used betting exchanges instead of bookmakers. And the other thing that I should point out is that these computer-based models weren't trading models, they were forecasting the results of sporting events. But nevertheless, they show that many betting markets are weak form efficient. If you're watching this video on YouTube and you want to see the references associated with this video, there is a link under the video to the transcript of this video on my website where you'll find the references. So, I haven't discussed inefficient markets yet. An inefficient market is when the price is incorrect and there are other market characteristics that don't fit into any of the EMH definitions of efficiency. Therefore, an inefficient market must have mispricing together with at least one of the following. Past price movements affect current or future prices, or historical or currently publicly available information is not factored into the price. For example, during the coronavirus-induced ghost games in which football teams played in empty stadiums, Meyer et al. Found that the odds of home teams were mispriced too low. The mispricings were sufficient for a trader or punter to make an overall profit. As the information that teams were playing in empty stadiums was public news, the authors concluded that these markets were weak form efficient at best. However, I would call these markets inefficient rather than weak form efficient, and the reason for this is that the information that the teams were playing in empty stadiums was public. For a market to be classed as weak form efficient, public information should already be factored into the odds. An important idea is that sports markets aren't static. They can change their level of efficiency throughout the day. This is just an example of how a horse race market might develop. So at 9 a.m. when liquidity is low, the market might be inefficient. As money starts to come into the market, it might become weak form efficient. As you get close to the start of the race, large amounts of informed money are likely to start to come into the market, which may lead to a semi-strong, efficient market. Then the race goes in play. During this time, liquidity reduces, which may result in the efficiency level of the market to vary. I'm not saying that a horse race market unfolds in exactly this manner. The point I'm trying to get across is that it's likely that efficiency varies in such markets. In addition, it's also likely that the market becomes more efficient as it approaches the start of a race. So now I'll talk about what causes inefficiency in a market. In finance, the word anomaly is used to refer to prices that don't fit into the efficient market hypothesis. There are two types of anomalies, which include market anomalies and pricing anomalies. I'll explain both of these, starting with market anomalies. Market anomalies are patterns of price change that contradict the EMH. The important feature of a market anomaly is that there's a pattern that suggests that there's a regular bias in the market. In financial markets, an example of a market anomaly is the weekend effect. This refers to reports that Monday's prices tend to close lower than those of the immediately preceding Friday. In addition, volume is lower on Monday compared to Friday, and there tends to be more sellers than buyers in the markets on Monday. In sports, an example of a market anomaly is the favourite long shot bias. I've written a whole chapter on the favourite long shot bias in my free ebook, Dobbing for Profit, that you can find on the sidebar of my website. The favourite long shot bias is a phenomenon in betting whereby punters tend to overestimate the value of long shots and underestimate the value of favourites. Effectively, this means that favourites are better value than long shots at bookmakers. However, due to the bookmakers' overround, betting on favourites still isn't a profitable bet. Basically, the favourite long shot bias means that favourites are minus EV, while outsiders are even more minus EV. Another example of a market anomaly in sports are trainer betting patterns. For example, I've said in other videos and in my book, Directional Trading on Horse Racing, that I've noticed certain trainers' well-handicapped horses get backed at a specific time, and that the timing of this backing is dependent on the trainer, and this is if the horse is going for the win. Pricing anomalies are when the price of a stock, or in sports trading a horse, is priced differently compared to EMH predictions. This type of market inefficiency may be due to low liquidity or informational asymmetry, which sounds complicated but it really isn't. I'll speak about both of these, starting with low liquidity. Although betting exchange markets parallel bookmaker markets, there may be moments where the betting exchange odds diverge from efficiency. Many of such moments may occur when there's low liquidity in the market. In weak morning markets, different traders and punters can look at form or statistics of a sporting event and come up with different conclusions. In such markets, it wouldn't take a lot of money to move the odds by several ticks. Many in-play markets are weak. The odds might not always change to efficient values when responding to new information. Examples of new information include goals and red cards in football. In such cases, odds may be temporarily affected by human error and emotions. In such situations, some markets may overreact, while others may underreact. The fact that low liquidity is associated with market inefficiency is important. We're often told by YouTubers that we shouldn't trade when liquidity is low. The argument is that you can't trade a large amount of money in a low liquidity market. However, compared to highly liquid markets, low liquidity markets are often volatile. Therefore, low liquidity markets offer the potential to make more money relative to the size of your stake. The theory is that a highly active market will become more efficient because inside information bets will enter the market from a range of sources. This situation is complicated because inside information money enters the market at different times. In addition, there'll be bookmakers and other smart money profiting by correcting inefficiencies. And this doesn't mean that we can't trade in high volume markets. Whether a market is efficient or inefficient, you need to have an edge to trade successfully. If you don't have an edge, you can still lose in an inefficient market. Differences in opinion, in which one party has more information than the other, is known as informational asymmetry. In this context, we're usually talking about informed traders with private information having an advantage over other traders. In a paper by Admarty and Fleiderer, financial traders were divided into informed traders and liquidity traders. Informed traders were classed as traders with private information. Liquidity traders didn't have private information. The liquidity traders might belong to financial institutions who are buying shares for clients. Therefore, liquidity traders might not be trading for the purpose of getting a short-term gain. However, they're still trying to get the best price. The authors found that liquidity traders obtained better prices when there were many informed traders in the market and the informed traders had the same information. That is, the informed traders all had the same opinion. In this situation, the liquidity traders are not beating the efficient market, they're simply obtaining a fair price. By contrast, in a market that's prone to inefficiency, the liquidity traders will obtain bad prices on average, and this is because they do not have inside information. And this makes sense. If there are many informed traders with the same opinion, they'll compete with each other to correct an inefficient market. In this case, the market will always hover around the efficient price, or at least the prices will remain within a tight range. By contrast, if the informed traders have different opinions, the market could swing in both directions, and in this situation, the liquidity traders won't know the final direction of the prices. And there's been some other research that's shown that if there's only one informed trader or a group of informed traders working together, they'll often hide what they're doing by making relatively small trades. In the context of trading on sports, we can reach an important conclusion from these findings. For scalping, the following two conditions may be preferred: a strong market with fewer outcomes. Why is this ideal for scalping? Well, firstly, a strong, highly liquid market is likely to attract many informed traders, and these traders will compete with each other to bring the odds to their efficient positions. Secondly, if there are fewer outcomes, it's more likely that the informed money will be in agreement. For example, if you have the choice between scalping a tennis match or a football match, and all other variables are equal, the tennis match should be preferable. This is because a tennis match has 2 possible outcomes, while a football match has 3 possible outcomes. If the informed traders disagree on the exact odds of a favourite, the odds should still stay within a tight range. However, if the informed traders disagree on the outcome of a sporting event, the odds are more likely to be volatile. And a tight range is good for scalping, whereas volatility is bad. The reality is that trusting an obvious pricing anomaly carries a risk, especially in horse racing. And this is because an apparent pricing anomaly can be associated with a horse being a non-trier. In other words, the pricing anomaly might not be a pricing anomaly at all. For this reason, I prefer to focus on market anomalies in combination with pricing anomalies. In this case, a trainer betting pattern, which is a market anomaly, may tell me whether the apparent pricing anomaly represents value or a non-trier. Therefore, I often use apparent pricing anomalies in reverse. For example, if I see a strong form horse drifting badly, I'll suspect that the horse may be a non-trier rather than the big price representing a value pricing anomaly. So what does this all mean for sports traders? The subtitle of this article was, "It is possible to find an edge in an efficient market." Under the right conditions, I've explained that there is potential to make money trading in markets that have various levels of efficiency. And in this video, I've explained what I mean by the right conditions. So, are Betfair markets efficient? Are Betfair markets strong, semi-strong, or weak form efficient or inefficient? The answer to that question is it depends on the market. For example, in some Australian horse races during the first lockdown, the odds didn't move during the last 5 minutes pre-race. This would be an example of a strong form efficient market, and you won't see such markets often. And to be honest, I don't really like using this as an example because in the races I saw, hardly any volume was getting traded despite the large amount of liquidity available. So I don't think that you'll find many strong form markets. However, you will find a lot of semi-strong markets. For example, in football, when a goal is scored during the 5 minutes before half-time, the market has been reported to adjust quickly. In this particular situation, the market is believed to be semi-strong because it reacts quickly and accurately to the new information. And this is a specific situation, and it doesn't mean that all in-play situations are semi-strong efficient. Weak form efficient markets have been shown by computer-based forecasting models making a profit from a range of sports. And an example of an inefficient market was the Mayer study, in which he found markets overestimated the winning chances of home teams during the coronavirus-induced ghost football matches. In addition, I explained how a sports market can change its level of efficiency throughout the life of the market. It's important for the sports trader to find an edge. By definition, inefficient and weak form efficient markets have potential edges within them. The challenge is to find these edges. In high liquidity sporting events with few outcomes, high liquidity strong and semi-strong form efficient markets may be okay to scalp. In this case, you have to judge whether the informed traders are in agreement with each other. And there's always a risk that there could be an informed trader with a different opinion waiting to take the market by surprise. I would say that to trade successfully, you need to find anomalies. The markets are not very liquid these days, therefore there are fewer opportunities to scalp strong markets. Although the efficient market hypothesis is by definition unproven, it does produce a useful way of classifying markets. This classification system can help us to decide whether we should trade a market. In addition, the system gives us an awareness of which methods that we should be using in each type of market. The disadvantage is that it may cause a trader to give up on a market too early. Let's say you look at a market and you can't find an edge. Therefore, you decide that the market is semi-strong efficient, and as you don't have inside information, you move on. However, there could be anomalies in that market, but you haven't found them yet. Therefore, the market could look semi-strong to a trader who hasn't found an anomaly. However, there could be another trader who sees the same market as inefficient because he has found anomalies. And the same argument could be used on any individual who claims that a market is too efficient to trade in. The individual might not have found an anomaly yet. So anyway, that's all for this video. Take care and good luck.